Most startups don't die because they don't have a product. They die because it costs them too much to sell that product. They spend aggressively on ads, sales teams, tools, conferences, content, and growth experiments without ever stopping to ask one simple question. For every dollar we put into acquiring customers, how much do we actually get back? That question is answered by one metric, the LTV to CAC ratio. Investors call this the golden formula of SaaS because it tells you very quickly whether your business is a money printing machine or a money pit. And if you misunderstand this ratio, scaling will make your company collapse faster, not grow. So let's break it down simply and correctly. First, CAC, customer acquisition cost. CAC is how much it costs you on average to acquire one new customer. The formula is straightforward. Total sales and marketing spend divided by the number of new customers acquired in the same period. But here's where most founders get this wrong. CAC is not just ad spend. It includes everything required to close a customer. Sales team salaries, commissions, marketing tools, agencies, content production, events. If your sales rep makes $10,000 a month and closes 5 customers, $2,000 of CAC comes from salary alone. If you ignore this, your CAC is fake. And fake CAC leads to fake confidence. Now let's talk about LTV, lifetime value. LTV answers a different question. How much profit does one customer generate over their entire relationship with your business? And this is where most founders make their biggest mistake. LTV is not based on revenue, and it is based on gross margin. This distinction is critical. If a customer pays you $100 per month, but it costs you $40 to deliver the service, your gross margin is $60. That $60 is what actually contributes to your business. So your LTV is built on 60, not 100. If you calculate LTV on revenue instead of gross margin, you will dramatically overestimate how healthy your business really is. Here's a simple way to think about LTV. Take your average monthly gross profit per customer, then divide it by your churn rate. If your average customer generates $60 in gross profit per month and your monthly churn is 5%, the average customer stays for about 20 months. $60 times 20 months gives you an LTV of $1,200. That is the real value of a customer, not the top-line revenue number. Now that we understand both sides, let's put them together. The LTV to CAC ratio is simply LTV divided by CAC. If it costs you $400 to acquire a customer, and that customer generates $1,200 in lifetime gross profit, your ratio is 3-to-1. That brings us to the benchmarks. First, the danger zone, an LTV to CAC ratio below 1-to-1. This means you lose money on every customer. You spend more to acquire them than they will ever return. Scaling in this situation is fatal. More customers means more losses. Second, the golden ratio, 3-to-1. This is the industry standard for healthy SaaS. For every $1 you put into the acquisition machine, you get $3 back over time. This leaves room to cover overhead, fund growth, absorb mistakes, and still build a real business. This is the ratio most investors want to see before a company scales aggressively. Now here's the counterintuitive one, the too safe trap. Ratios of 5-to-1, 7-to-1, even 10-to-1. At first glance, this looks incredible, but often it signals a different problem. You are underinvesting in growth. If your acquisition engine is extremely efficient, but you refuse to spend more, competitors will happily take the market share you leave behind. In SaaS, being too conservative can be just as dangerous as being reckless. The goal is not to maximize the ratio. The goal is to optimize it. Now let's talk about how to actually improve LTV to CAC. There are only 2 levers, lower CAC or increase LTV. Let's start with lowering CAC. This usually means better targeting, more focused ICPs, cleaner messaging, channels that compound, like content or referrals. Organic marketing, partnerships, and product-led growth can dramatically reduce CAC over time. But there's a limit. CAC can only go so low before diminishing returns kick in. Now let's talk about the more powerful lever, increasing LTV. For most B2B SaaS founders, this is where the real leverage lives. There are several ways to increase LTV. Raise prices, especially for new customers. Introduce upsells and cross-sells. Move customers to annual plans. Reduce churn by improving onboarding and activation. Even small improvements here have massive effects. If you increase LTV by 20%, without changing CAC, your entire business model improves instantly. Margins expand. Payback periods shrink. Growth becomes safer. This is why experienced founders focus so much on retention, expansion, and pricing. Acquisition gets you customers. LTV determines whether they were worth acquiring. Now here's the key takeaway. Do not scale until your LTV to CAC ratio is healthy. If your bucket is leaking, turning on the hose harder just floods the room. Fix the economics first, then scale. The LTV to CAC ratio is not just a metric, it's a filter. It tells you whether growth will reward you or punish you. And the founders who understand this early are the ones who build companies that last.